I'm Priscilla Barrera with the Investing News Network, and here with me today is Anthony Milewski, CEO of Cobalt 27. Anthony, thank you so much for being with us today.
Thanks again for having me back.
All right, so we're once again at PDAC. What are you looking forward to the most at this convention?
You know, I always like to take the opportunity to look at new ideas, go and see CEOs and executives from companies where we have streams and royalties, and really kind of catch up on the company's plans for the next 12 months and see where opportunities may lie.
All right, so let's talk about Cobalt. We are entering the month of March, the last month of the first quarter. Has Cobalt performed as you expected so far this year?
So what we've seen in particular since kind of last June is a significant and material sell-off in Cobalt. It was as high as 44, and today it's around 15. And that's really been driven by artisanal supply out of the Congo. And so what we've seen in this pretty material move down in Cobalt price is that there's about a $29 to $31 ceiling in the near term on the Cobalt price that is directly linked to artisanal Cobalt production out of the Congo. Artisanal Cobalt production is people showing up with picks and shovels. And so we've seen that move down. I think it's overreacted. We're at kind of $15 today, and I anticipate that through the balance of the year, we'll see Cobalt move into the mid-20s again.
All right, so you are expecting this year to be the year Cobalt rebounds then? Will be going higher in prices?
It will definitely rebound off what is an extremely low base. I mean, we're below the 20-year average with a massive increase in demand. The uptick in EVs has been tremendous. If you look at several years ago, average new car sales that were EVs in the US was 0. You're now over 2.6%. So the demand side of the story is extremely strong. We just had a pretty significant artisanal response in the Congo. I think that works its way out over the balance of the year. And then you see the Cobalt price trend up with a $30 ceiling in the short term. In the midterm, of course, when the demand really hits, you'll see it move through that ceiling, but that's probably 18 to 36 months out.
All right, so let's just switch gears for a second and talk about nickel, another battery metal. You recently wrote an article about it, and there's a lot of talk about whether nickel is actually a battery metal or not. Do you actually expect demand from the battery sector to be the primary sector for demand of nickel in the near future, or is it more a bit of hype?
Yeah, no. So I think nickel is more complex than the cobalt market. It's driven in large part by Chinese steel consumption today. And there's different types of nickel. There's class 1 nickel, and then there's nickel pig iron. And what I would tell you is the new demand for nickel, which is tremendous, will come from batteries. So the primary chemistry today in the electric vehicle is the nickel manganese cobalt chemistry, which, by the way, is used by every single automaker in the world, save it for Tesla. And they also have a nickel rich battery, which is a nickel cobalt aluminum battery. And that battery started off at a 1:1:1 ratio. It's moved into a 5:3:2 ratio, and over the course of the next 6 to 8 years, it will eventually move on to an 8:1:1 ratio, being 8 part nickel, 1 part manganese, 1 part cobalt. And so what you see is, as these batteries become increasingly nickel rich, tremendous pressure will be put on the nickel market, the class 1 nickel market. And so you have nickel trading, in a range today. I don't know if it's at $6 or where it's at exactly today. And, the price of nickel will easily move up to the inflection point where nickel pig iron can be converted into class 1 nickel. And it's our view that that is, materially higher than today. And so you see upside in the nickel price just based on the new demand coming in from batteries. And also, nickel is sort of unique. And that if you look at nickel projects globally, CapEx is in the billions of dollars. So in today's financial markets, it's very challenging to raise $100 million, let alone $2 billion. And so the response on the supply side for nickel will take a much stronger nickel price in order to incentivize building those mines. And look, that's frankly one of the reasons why if you look at some of the nickel projects where we've acquired streams and royalties, we've focused on projects which can be retooled to have a lower CapEx. One of those is Dumont. They're working towards retooling that project to have a materially lower CapEx. Another one is Turnagain. If you talk to the CEO, he'll tell you how they can maybe bring that CapEx down into the $600 million range. So, one of the things we're looking at on the royalty side are nickel projects where a capex can be, or the capex can be realistically met in a market that's not going to really fund a $2 or $3 billion capex project today, in my view.
All right. And aside maybe from prices and battery technology, are there any trends that investors might be missing right now? Is there anything that we should be talking about in terms of the battery metal space that we're not talking about enough?
Yeah, so I think one is copper. So depending on your, depending on what you think the penetration of EVs is going to be as a percentage of new car sales, as much as 15% of copper demand, out into 2030 is going to be from electrification. So more broadly, not just electric vehicles. And you have a market which is basically in equilibrium. So I think that copper is exceptionally interesting in the coming few years as well, especially as you have old mines with declining production. But I think that investors continue to fail to see the magnitude of change. You're talking about a structural change in two of the most important markets in the world, namely the automobile industry and the energy industry. Something like 60% of all crude comes from electric vehicles. So in addition to being long nickel, long cobalt, long copper, I think investors really need to think about what are the consequences for my other investments if, by the way, 50% of new car sales are electric vehicles in 2030, which is, by the way, Canaccord's number. So, in addition to being long, I think there are stocks that you're not going to want to own. I wouldn't want to own an automobile dealership that's selling used cars, for instance. So I think it's not just a long scenario, but there are also going to be shorts just based on these very important structural changes which are underway. And, if you look at when people make money, big money, they make money when you have an industry which is in transition. And you have an automobile industry in transition. Electric vehicles really accelerate autonomous vehicles and autonomous driving. And so maybe that changes automobile ownership a decade out, maybe ride sharing. So there are these big changes underway, and I think investors really need to kind of take on the rate and pace of change. There was a month at the end of last year where 10% of all new car sales in California were electric vehicles. So this is happening extremely fast.
Wow. All right, so let's talk a little bit about Cobalt 27 specifically. You struck a deal to acquire the Australian company Highlands Pacific. How does that fit into your overall strategy? Are you looking to invest more in nickel royalties? Are you moving away from cobalt? Are you just adding nickel to just have more exposure to battery metals? Tell us about that.
If you look at cobalt globally, inside of the Congo, it's associated with copper. Outside of the Congo, it's almost universally, save it for one mine in Morocco, associated with nickel. And so when we show up and meet with a management team, we're solving a problem for them. And that problem could be anything. And having the flexibility to stream and or do a royalty across nickel and cobalt can be an important part of a financial solution. So, we're incredibly bullish on cobalt, we're incredibly bullish on nickel, and Highlands Pacific presented a unique opportunity to get exposure to both of them at the same time. So it was really right on strategy for us. I would anticipate in the coming 12 to 18 months, we continue to focus exclusively basically on nickel and cobalt because both of those metals really are going to come under demand pressure as the adoption of the electric vehicle accelerates.
All right, my final question for you then, you're going to be focusing on nickel and cobalt. Any other milestones that investors can expect from Cobalt 27 this year?
So I think the first big milestone is obviously the closure of that transaction, hopefully by mid-year. After that, then you are cash flow positive, and we've told our shareholders that a share buyback, a dividend, a combination of both, all those things are on the table in the context of the market at that time. And so I think it's going to be, number one, closing that transaction, and then two, really pivoting into a company that has free cash flow. So that's what I would see as big moments for the company. If you look at it like a Sandstorm, as an example, when you saw Sandstorm achieve its kind of streaming and royalty multiple, when I look at the chart at least, I see that was when they had cash flow. And so, there's this range of 0.8 times to 3 times that streaming and royalty companies trade at. we're kind of at like 0.3 times today. We're trading at a fraction of our NAV. And I think that for investors, when we're able to actually show cash flow later in the year, that will be a moment where we can transition into a company trading within the streaming and royalty multiple range.
All right, Anthony, thank you so much for joining us today.
Thank you.
All right. Once again, I'm Priscilla Barrera with the Investing News Network, and here with me today was Anthony Milewski, CEO of Cobalt 27.